little bit. So, well, hello everyone. Hello to all participants. Hello, Michael. Um,
Hello.
I welcome everyone to this presentation, High Frequency Trading, New Challenges in Financial Markets. I will introduce myself briefly. I'm Celia Gueto. I work in the communication department of Fatima Al-Fihri University, and I was an economics student in the UK, actually with Michael, at the University of East London. A little bit about our speakers. So Michael is a Ph.D. candidate in financial economics within the Royal Dock School of Business and Law, which belongs to the University of East London. His research expands upon the concept of non-cooperative interaction within financial market microstructures, which are dominated mainly by high-frequency traders. Before this, Michael obtained a master's degree in economics from Birmingham University, and currently he also lectures in the areas of business economics, econometrics, and financial trading. So thank you very much for accepting our invitation today. It is a pleasure to have you with us. Before you begin your presentation, I just would like to put this talk a little bit into perspective. So when I approached Michael, because I wanted him to participate in one of our events, he suggested the topic of high frequency trading. And I thought, what the hell is this? It sounded very complicated to me. But I started gathering information, mainly with your help, and I realized that it was a topic that could easily be analyzed and understood from a wide array of perspectives. So for instance, I came across behavioral economics, game theory, regulation in financial markets, or even it made me rethink on the accuracy of mainstream economics. So I'm not going to spoil any more this presentation for everyone. I'm looking forward to hearing you. The floor is yours.
Well, fantastic. Well, first of all, thank you very much for agreeing to chair this and taking a risk in inviting me. I certainly don't think you were expecting high-frequency trading. Oddly enough, high-frequency trading is the hot topic now in financial markets, yet you hear so little about it. Even if you read the Financial Times, you get one article a month if you're lucky. I've never actually heard anyone speak on high-frequency trading. So today you've set me a challenge. I've got to deliver this assuming absolutely no knowledge, and you have ordered me that I've got to keep my right eye on the clock while I do it. So this can be a little interesting. The apologies for the late start. I insisted on using Zoom, and of course, we tested it and it worked beautifully.
This always happens.
Well, this morning. But every conference I ever present at is cursed.
It had to happen.
Today is no different. Okay, let's get started since I'm on the clock. Half an hour maximum to try and leave some time for questions. Okay, let's very quickly try and deal with what high frequency trading is as a concept. I'm sure we've all heard of people buying stocks and shares. We might not know what stocks and shares are, but when we think of this, we think of movies that show images of Wall Street trading rooms, and we think of lots of people, mostly men, buying and selling just by screaming at each other, waving bits of paper. In more recent films, they all have iPads, but it's still a human process. However, the reality is not this. The reality is most financial assets are now bought and sold by machines. Well, a machine is simply a large collection of lines of code. It's programmed to perform a task. These are known as automated trading systems, and an automated trading system which is designed for sheer speed is a high frequency trader. So these are algorithms. Now, these algorithms are designed in slightly different ways, but most of them are designed to pick up information, action it as quickly as possible. So the first concept we need to pick up is information. Now, for those of you who don't know, let's quickly talk about what financial assets are, because these are marketplaces. They're exactly like the supermarket where you could go to buy a loaf of bread, but what you're buying and selling is, shall we say, different. Let's stick with that example. If you go to the shops to buy a loaf of bread, you have what is called a tangible product. Tangible just means you can get hold of it. In the case of a loaf of bread, you take it home, you make sandwiches, you eat it, you get your utility through consumption of the bread. It's all pretty simple. You can work that out because we've all done it thousands of times. However, a financial product is not tangible. You can't get hold of it. I mean, at best, a financial product only exists as a piece of paper that you hold. In modern financial markets, you don't even get the piece of paper to hold. A financial product is, shall we say, a claim on a revenue stream. There are two broad types of financial product. The first is what we call equity. You'll probably call them stocks or shares. For example, if I own shares in British Petroleum, big UK company, that gives me a small claim on the profits of British Petroleum.
Yes.
So if I hold that share for years, when they make profit, they pay me dividends, so I get a small income. So you see, this financial product is a claim. The other type of financial product is fixed income. These are not a little less well known if you haven't studied finance, usually called bonds. These are, again, just big bits of paper that have IOU written on them. You buy the bond, so you give the firm money, they give you an IOU note. In 10 years' time, you get the money back and you earn some interest every year that you hold the bond. And you can buy and sell these things secondhand. So you must understand that the value of these items is very subjective. So the value of a financial product firstly derives from its expected returns over time. And we know that people are not always very good at calculating the expected returns over time. Also, because they relate to typically large companies or governments, any factor at all which affects that company or government will have some effect on price. Pardon me, we know that similar assets should be similarly priced. It's just to give a quick example of that. I own quite a lot of shares in BAE Systems. They are primarily an arms manufacturer. Every time there's a war somewhere in the world, BAE Systems share prices go up because somebody thinks, oh, well, they might start selling things. It's perhaps not very kind to be betting on wars and trying to make profit from it. But it's a simple example, and hopefully you can now see that there's a whole myriad of things which can affect the price of a financial asset. So now it might be helpful if I characterize for you what a financial exchange is actually like. Now, I'm going to try and be clever. It won't let me share my screen, so that's not a problem. All I was going to show you was an old photograph of a financial exchange. Financial exchanges are not new. The earliest account of a financial exchange dates from the 1600s, the 17th century. There's a chronicle by a Dutch trader named Joseph de la Vega. And it's very hard to get to actually read de la Vega. There's very few copies and you can't even buy them. But I was lucky. And the de la Vega's account of an exchange really did mirror exchanges that were running in my lifetime. The London Metals Exchange, which was entirely human, no ATS until I think it was 2013. And so I was an economics student, and I've been there and seen them shouting at each other. The market structure hasn't changed. You just get a large number of people. They tend to stand in a circle and scream and wave at each other. This is much less common now. Almost all new exchanges are electronic. I think the first electronic exchange was the NASDAQ exchange, and I've jotted down that was started in 1971. Almost all major exchanges around the world are now electronic, which means you can now interface high-frequency traders with them. One point I should mention is that if I go as far back to de la Vega didn't have to deal with the international element of finance. Because finance relies so much on information, as information can move around the world more freely, finance takes on a much more global trace. So in around the 1860s, we start to see transatlantic cables. So you can now send telegraphs between London and New York. Around the same time, a company called Reuters was founded. You may have heard of it. Well, Reuters today is an information service. And Reuters actually started out flying pigeons between London and Paris with small notes, because it was quicker than sending a letter. And of course, you couldn't make a phone call because you didn't have a telephone, because it hadn't been invented yet. So the global element, I think, will get stronger and stronger and stronger. We are now at a stage where financial exchanges are using the fastest thing in the world, which, for those of you who know your physics, is the speed of light. Incidentally, the New York Stock Exchange sends information via light beams across the USA to Chicago. If you had a small child with a helium balloon and they just put the helium balloon into just the right place, you could take down an entire stock exchange. It's quite frightening to think about that, but I would imagine you'd need that balloon to be on a very long string, but it's possible. And if you want to do some financial terrorism, there's an idea. Just don't blame me for giving you the idea. Okay, one thing I must say about electronic markets is that predictions of how the ratio of high frequency traders to human being traders are a little bit hard to obtain. The best statistic that I've ever found is the following. I'm thinking 73% of traders in American equity markets are high frequency traders. So basic arithmetic, what does that give us? 23% are likely to be human or very slow computing. Just for the sake of clarity, my source for that is Maureen O'Hara, 2011. Now, I know what you're thinking. Why are you citing a source which is 9 years old? So far as we can tell, this ratio has plateaued over the last 10 years. So I can get away with citing a slightly older source. The reason I think this has plateaued is because high frequency trading requires extreme computing power. And as you can probably work out, that is not cheap to set up. Now, I know quite a lot of my own students, and I think I've seen a few names that I recognize on here already, are interested in trading and do trade on their own accounts. So before anyone asks me, you cannot set yourself up as a high frequency trader trading in your bedroom. The problem is you do not have the money to set this up. So just to clarify a little on what high frequency traders do, I've touched on it a little bit, but I'll hammer home the point again. These traders have a real need for speed. Let's walk through the process of what a high frequency trader does on a day-to-day basis. A high frequency trader is gathering information. A lot of these traders, they scan Twitter, they scan Facebook, they're scanning a whole host of news outlets, they're watching companies for annual reports. They're getting as much information as they can, and they use artificial intelligence to try and process this. So artificial intelligence consists of concepts such as sentiment classification, machine readable text. So let's imagine a high frequency trader reads BBC News. They have to identify which company, which assets this applies to. They've got to gauge the sentiment. Is it positive or negative? What effect will this have? Then they've got to evaluate the price of the relevant assets and quickly decide, are these assets correctly priced? Is this information already reflected in the price? Because we as economists believe all information is reflected in price. It's a controversial point, and I might come to it if I have time. So they've got to make that decision. And then, if they decide this asset is not correctly priced, they have to submit an order to the exchange. There's a whole host of order types. Usually they'll use limit orders. We won't go into hide not slide orders. That's a bit advanced. Now, what I've just described sounds like an awful lot. If a human being does it, it's probably going to take you the best part of 15 minutes. to do all that? Well, let's have a bit of audience participation. Grant me an indulgence. Blink for me. Right, how long did it take you to blink? Well, I'll tell you, it took you less than 1/10 of a second to blink. A high-frequency trader can do all of what I've described in half the time that it takes you to blink. So now we come to my research area, which Celia described, non-cooperative interaction. Okay, so if you have a high-frequency trader in the same market as a human being, you can see where I'm going. Who will be the fastest? And if I blink, I've missed it. High-frequency traders will always try and get to the front of the queue. I thought I came up with a very good analogy for this yesterday. Now, I know you're all in different parts of the world, but in the UK, on the 26th of December, most shops open very early in the morning. It's called the Boxing Day sales. And you'll be amazed that people will get up at 4 o'clock in the morning. They'll walk to these shops because there's no public transport but at that time in the morning, and they'll queue up outside because they want to be the first. They want to get all the bargains, all the items which are priced very low. Well, high frequency trading is and financial markets, they're playing this game. Everyone wants to be at the front of the queue. They need to submit their order first so they can correct the price because they earn a small profit when they do. Now, when you think of high frequency traders, you're probably thinking big money. Wrong. High frequency traders make a little bit of money every time they trade. Sometimes it's a couple of US cents. On a good day, they might make a couple of dollars. But now we come to the term high frequency. They are trading all the time. They don't stop. So it's a couple of cents every time. So overall, they are profitable. I think we've now reached a point where they've plateaued. They're not making as much profit as they once did. The reason why is very unclear. Maybe if anyone wants to ask me a question, you can give me a bad day on that. So hopefully I've now clarified that there's a need for speed. You can think of this as a technological arms race. That the technical term for what I've just described is called latency arbitrage, trying to get into the front of the queue before everybody else. So now let's clarify a little bit about how the two types of players in financial markets actually think. Well, let's start with algorithmic traders, since we've talked about them for a while. These are lines of code, as I've already said. Now, most lines of code follow a principle which most economic students will know. It's called von Neumann and Morgenstern preferences. If you've ever been forced to do a very mathematical microeconomics module, you've probably had the pleasure of meeting this. For those of you who are new to this, the VNM preferences just take a predicted probability multiplied by the outcome, and then the trader will have to rank scenarios. They'll have to make a preference set. And again, this is very conventional microeconomics. This is the sort of microeconomics which dates from around about 1730, that Adam Smith. Basic economics has not changed since then. I love being an economics lecturer because my discipline never changes. My colleagues in computing retrain every year. I won't retrain in my lifetime, which saves me time. Now let's come to human beings, because human beings do not have computerized rationality. Indeed, there is a movement in economics now that human beings do not have rationality. It's been a long-held belief in cognitive psychology since probably the 1970s that humans are not rational, and we can start to explain why they're not rational. This is now becoming popular in economics. So psychology is now moving into economics a little bit more to explain, well, how do we actually make decisions? Why do we make the choices we do that appear to be irrational? So I could talk all day about behavioral economics, because I've been lucky enough to teach it. Ordinarily, I do one topic in 3 hours and I've got 24 weeks, but I like this topic, so let's try and do a couple of topics with just general examples. I think anyone studying psychology will enjoy this, and I'll keep it as simple as I can. First of all, let's talk about how people deal with losses and gains. So a financial trader either earns money or he loses it. So how does he deal with this? Well, it's been a known adage in economics that people undervalue gains and overvalue losses. Galbraith noticed that in 1962. And it jumped forward 20 years, you end up with Daniel Kahneman and Amos Tversky, who formalized this theory. They call it prospect theory. Right, let me give you an example that I find works. Now, I'm told your university is based in Morocco, so let's do an example with Moroccan dirhams rather than pounds or euros. £1,000 is around and about 10,000 dirhams. So imagine I give you 20,000 Moroccan dirhams. If you're not in Morocco, that's about 2,000 euros. Now, no strings attached. I don't want anything. I've just given you 20,000 dirhams. Overall, you're happy. I hope you're happy. No strings attached. You've just got the money. Well, economic theory says I've raised your utility level significantly. I presume you could easily spend that money for me. Okay, well, now let's imagine a bit further. Let's imagine a thief comes along and they steal 10,000 Moroccan dirhams from you. So I gave you 20,000, someone's taken away 10,000. Now, the calculus of this is you've still got 10,000 dirhams that you didn't have 2 minutes ago. So if you do the maths, you're still 10,000 dirhams better off. But let me ask how you feel. Now, the problem is I can't actually see your faces, but when I do this with my own students, I just ask them, are you happy or you're sad? They all say that they're sad. They feel a negative emotional response. So the disutility of losing 10,000 Moroccan dirhams was greater than the relative utility of gaining 10,000 Moroccan dirhams. So whilst an algorithmic trader would think, I've won, I've got 10,000 dirhams that I didn't have 3 minutes ago, the human being trader, he's got the 10,000 dirhams, but he feels like he's lost. Mm-hmm. It provokes an emotional response. He thinks he's losing. So this is a fallacy that human traders fall into. We subconsciously do it. The same thing if you lose. I once lost my glasses and I started getting very angry. I didn't become extremely happy when I realized I was actually wearing them whilst I was looking for them. But that's a human fallacy. The next thing we should probably talk about is cognitive reflection. If I stop and think about this scenario of gaining 20,000 dirhams and losing 10,000, if I sat down and actually thought and maybe got the calculator out, I might realize that I'm still 10,000 dirhams better off. But if I just think quickly in the moment, I think I've lost. And this is called cognitive reflection. There are two ways of thinking, according to cognitive psychologists. It's called thinking fast and thinking slow. What might be the best way to give an example? Let's imagine we're driving a car. Well, let's imagine you're driving a car. Now, if you've been driving for a long time, you develop something which is known as a heuristic. The heuristic you learn is just a response to a situation which you often see. So I've had my driving license for around about 10 years. When the car in front of me starts to brake, I don't really think. I just start braking as well. When the car in front of me stops, I don't think about it. I just brake a little harder, dip the clutch and go into neutral. However, think back to when you learnt to drive. So when you drove a car for the very first time. So you'd never done it before. You have a much different thought process. It would be something more like, I can see the brake lights of the car in front. I am getting closer to the car in front. I need to slow down. I need to go off the throttle, press the brake. I'm still getting closer. I press the brake more. The car in front is stopping. I will need to stop. I must dip the clutch, continue braking, ease off the brakes, into neutral, handbrake on. That's called active thinking. However, once you've encountered a scenario many times, you don't need to active think, you just automatically do it. This is why people who've been driving for years can eat an apple, read a newspaper, send a text, and still drive the car. Incidentally, you shouldn't do all that. I'd make that joke because someone in the UK was actually caught doing that a few years ago. And for the record, don't do it because they're in prison at the moment for doing that. So this is the difference. There are two ways of thinking, and you can only think fast based upon experience. So human beings are great when they've done something many times before, but they're terrible if they are not able to switch between the two methods of thinking. And people are not very good at that. The behavioral literature shows us this. It's called cognitive reflection. Some people are better at it than others. Most financial traders who are still human beings actually receive training now to try and improve their cognitive reflection ability. There's a real problem with cognitive reflection in the literature, though, because there is a designated cognitive reflection test. The problem is a lot of people who take the test have been shown to have taken it previously, which means they know how the test works. If you want to know a bit more, the cognitive reflection test asks a series of challenging questions. It monitors whether you get the answer right and how long it took you to answer it, to try and assess, did you answer with type 1 or type 2 thinking. Since time is vaguely on my side, let's talk about a third behavioral effect. It's a little bit less prevalent in finance, but it's a very good effect to know for you. Let's talk about something called hyperbolic discounting. Well, let's ditch the technical term. Hyperbolic discounting means that people value things that they receive now more than they value things they receive in the future. So in economic language, we prefer utility now, we over discount utility we receive in the future. And it's this heuristic which explains why students procrastinate. They get more utility from watching videos of cats and dogs on YouTube than they do from the long-term goal of passing their econometrics coursework. If any of my students are here, do your econometrics coursework. This also explains why people very much struggle to give up smoking or anything which is addictive. They value the utility of one cigarette now more than the health benefit 10 years later of having given up. This hyperbolic discounting, it's not so prevalent in equity markets, but you could certainly make an example that this is very relevant to the bond markets, because these assets have a horizon usually 10 years. Some bonds now go up to horizons of 30 years. I wouldn't recommend buying them, but it depends on your risk preferences and what your portfolio actually needs. Oddly enough, 30-year horizon bonds are incredibly popular. A lot of pension funds buy them, or a lot of unit trusts buy them. So there is a need for them, but you have to try and break the rationality here. So when those of us who have studied microeconomics, we were told we always assume rationality. Now we see there's a lot of material you can apply to economics to show that if you amend the model, you can show that people are not rational and you can actually explain their behavior. The problem of economics for centuries has been it can't actually match reality. And this is why. Half of economics tries to understand why do people make choices. And we've never actually understood how people think. So when I was a student, we didn't get the option to study behavioral economics. We might have had maybe 2 lectures on it if we were lucky. Now at the same university, it is mandatory to study it. And this is slowly becoming the norm around the world now. Okay, so I've got about 5 minutes. So what's a good way to wrap this up? Well, if I've got 5 minutes left, I might tell you about market crashes. We all love a good disaster. maybe that might be an exciting point to end on. High frequency traders are lines of code. However, they have a risk characteristic. They are risk adverse. They don't make a lot of money on every trade they make. So they want to make sure they are right. And remember, high frequency traders have no ability to think in different ways. They can't do cognitive reflection. They're not programmed for it. A human being has the ability to step back, look at the bigger picture for 30 seconds and think, this is what's happening, this is what I do. High frequency trader does not understand the concept of sit quiet for 30 seconds and think. They charge. All they do is charge. It's like a horse that's bolted for 8 hours a day. So when any stochastic, that means random market event happens, how do high frequency traders deal with it? Now, there's been quite a few events, as the literature calls it. I think the first big event was 1987 on the NASDAQ. The biggest event was probably May 2010. Let's talk about May 2010. We call that event the big flash crash. That's the technical term. It is. All that happened here was a human being made a mistake. And well, what makes us human is the fact we make mistakes. All this guy did was he was trying to type in he wanted to buy 30,000 shares, and he accidentally pushed the 0 key just one too many times. So he bought 300,000 shares. And when you buy large amounts of a certain asset, you cause an impact on the price. In this case, he caused the price to rise a little bit. It was an accident, and these things happen. But the problem was high frequency traders were in the market, and this is an example of non-cooperative interaction. They all think, oh no, what don't we know? Why is the price rising? Well, we don't have time to think about it. The price is rising, so we don't want to hold these anymore. So they all started selling. Well, when they all start selling, the price goes down. And when I say down, I really mean down. But then other high frequency traders come and think, oh, what don't we know? This is really cheap. Buy, buy, buy. Oh, good, the price is rising. Sell, sell, sell. And it just kept going up and down for the best part of 20 minutes. The price went down more than up. The net result was the asset prices across the exchange started fluctuating, and they were down about 10% at the end of the day. Now, in this market, there are a system of circuit breakers. When prices start to fall very rapidly, trading stops. That's called a circuit breaker. It's rather like the circuit breakers you have in your house on your electricity supply. When the power surges, the breaker opens, it stops the flow of electricity. Mm-hmm. And that means that gives you time to work out what's gone wrong and correct it. Circuit breakers open, they halt trading. The idea of halting trading is it gives people time to work out what has gone wrong and start doing the right thing. The problem is the circuit breakers in financial markets close again automatically. Trading starts after 30 seconds. When the breaker opens again, the halt is a minute. When the breaker opens again, only on the third opening does trading stop for the day. So when the breakers when the breakers close, to use the physics term, the madness just kept on going. So trading had to be suspended for the day. The breaker opened for the third time and trading was halted. And that time gives people a chance to process the information. It lets the high frequency traders slow down. They're no longer battling each other to become top of the order book. Now, for my last 2 minutes, how do you deal with this? Evidently, the markets having circuit breakers is a good idea in this example, but not all markets do. In the US and most of the European markets, we have circuit breakers. There's a lot of high frequency activity in China, which may surprise you. Chinese markets do not have circuit breakers. There's a few emerging markets don't have them either, but some of the real emerging markets have much slower speeds and much fewer high frequency traders. But how do you regulate this? The financial sector does not like regulation. It lobbies against regulation. Most governments do not like extreme financial regulation because they don't want this financial activity to go somewhere else where there's less regulation. It's called regulatory arbitrage. And the literature does show when governments get tough on regulation, the banks and financial traders just go somewhere else. A lot of companies in the City of London, they're terrified of what will happen after Brexit, so they have gone to Ireland, which means I'm applying for my Irish passport back, because I was an idiot to get rid of it. Very quickly, the neoliberal system does not really allow for regulation of financial markets. It has two tracks of laissez-faire, which basically means leave markets to their own devices. People will sort themselves out. In the liberal spectrum, we have a discipline called ordoliberalism. It's a little less well known. But if you know any exponent of ordoliberalism, it's likely to be Friedrich Hayek. He's quite famous and he's very popular in my house, where I'm the only economist. He's not very popular in my place of work, where my colleagues are all very left-wing, and I'm not. Ordoliberalism splits the laissez-faire tract in half. It means that governments can start to regulate markets and control the market structure, but they place no regulation on who can participate. So could ordoliberalism provide a structure of conform regulations? Possibly not. So perhaps if you really want to bring stability to financial markets, it may be the case that you need to consider quite authoritarian structures of regulation. And I think that will be an immense challenge, given no company will ever advocate it. I can't think of a government which would have the political will to do it.
Yeah.
In a lot of the larger economies, finance is a core part of the economy. Just to give the UK as an example, we don't really make anything in the UK anymore. There's no physical manufacturing. We are a service sector economy. The largest component of our economic activity, GDP, is finance. It would be a bit silly to alienate them all to cross the Irish Sea and make Dublin their home. Although this is likely to happen, we don't know what's going to happen regarding Brexit. It does not look like we will get a common rule book which will allow these firms to operate in the European Union, given that the City of London is the clearinghouse of Europe. Maybe we are dead and buried, and perhaps we should just be disconnected from Ireland and we should just drift off into the middle of the North Sea. On that rather depressing note, well, actually, I didn't mention COVID-19, so I kept it cheerful. I think that's a very good place to stop because that gives a bit of time for Q&A. I see some people have been active in the chat, so hopefully there's a couple of questions.
Okay.
Thank you very much.
Thank you, Michael. This was very insightful. So I'm going to start with a question myself, then I will open the mic for the participants in case anyone has a question. Also for the participants, feel free to write down your questions in the chat. I think Michael is having a look at it, or myself. So I will
names I recognize.
Open the mics for the participants. Okay, so now you will be allowed to be back in the conversation. So my question is a bit weird because I was listening to your presentation. So I really like the part of behavioral economics. As myself, someone that believes that economics need to be less mainstream, we need to rethink our discipline and we need to be trained, such as computer engineers, as you mentioned. It's not normal that what I was taught in the 80s is what we're teaching now. Anyway, on another note, if high frequency trading helps to regulate the prices or to correct the prices, why is there so much arguments against it? No? Wouldn't it be a good solution to hope the markets are not so volatile? Or
okay, so I think the crux of this is volatility. You're absolutely right. High frequency traders do have the ability to bring information into prices.
Mm-hmm.
I think they do have the ability to bring some price stability at times. They're very good arbitrageurs. They fit in brilliantly with a lot of the old financial models. However, when things are going very nicely on a calm and quiet day, they do hold prices to be very stable. However, in volatile events, they are known to react very badly to changing prices. If they cannot understand why the prices change, they react very aggressively and actually destabilize prices. So there are swings and roundabouts to this. Some days they are doing a very good job helping. Some days they create absolute nightmares. I think we've got to understand that since the 1930s, most people who trade in financial markets, they're not just buying or holding on to it. They buy and sell at different prices. They follow the capital gains approach. And this is what really makes the markets unstable. And that criticism isn't mine. It comes actually from Keynes in 1936. Keynes hates this way of trading.
So the solution could be to regulate heavily in a way, but not really to get rid of high frequency trading, and then to apply structures such as circuit breakers.
I don't think getting rid of them would particularly help. I mean, in every market we see forms of innovation, and when you ban one form of innovation, you just get another form of it. It's exactly the same as the gig economy. Companies like Uber, they're not taxis. They're a provider, so they don't obey the same regulation as taxi cab providers. You will always get this form of innovation. I think it may be better to have a common rule book across markets. I think circuit breakers do certainly help protect against these flash crash type events. There's also a second tract of regulation which I would like to pursue, and in fairness, I haven't mentioned it in the talk. When high frequency traders provide liquidity, they often provide and then withdraw in less than the human reaction time. So human traders can't really buy from high frequency traders. So there's this limit in the market, which means it's very difficult to interact. So in one market, you essentially have two teams. I think this is a slightly greater challenge. And what's starting to happen is that we're seeing more and more new exchanges pop up. Some of them have very strict rules to ban HFT. But of course, this makes it harder to buy and sell because there's now 3 or 4 different places you can buy and sell. And now we're into the realms of shadow banking, dark aggregation. And I really don't want to go into how the MiFID rules do and don't allow this. So in a way, I think there needs to be some microstructure controls to help encourage high frequency traders to make the price stability. I think high frequency traders need to be forced to make cross position checks. Currently, they're not in any European or US exchange. Also, it may well be that, I can't believe I'm going to say this because I'm normally quite a right-wing economist, it may well be the case that governments will have to think about creating monopoly-type exchanges. And for those of you who study economics, you'll know how controversial that topic is. Usually we do not like monopolies, we do not create them. But it would be a very interesting aspect of order liberalism, and could probably write a whole paper on that. I think that hopefully I've touched upon the question and rambled a little bit more.
Let's see if anyone has a question. They can also write it for the... there's a question on the chat. For the high frequency traders, both system of thinking are embedded, fast and slow. Well, it was actually a question.
Well, it's got a question mark, so let's discuss it. For high frequency traders, they don't really think either fast or slow. Thinking fast and thinking slow are human characteristics. High frequency traders are simply just lines of code. They have no ability to change the way they think unless it is explicitly coded in. Naturally, we don't really get to see a lot of examples of how high frequency trading systems work. That's super secret information. You can't freedom of information request it, for example. From what I do know about how these systems work, and I've been going through spent about a year going through patent applications to try and get an insight. I've never come across a decision gate in the process which actually causes them to stop and think slowly. High frequency traders have such an incentive to be the first into the market, the first to change the price, that they use massive information that we could not process. They use supercomputing, but I think generally they are a little bit more akin to thinking fast than thinking slow. But you can't really apply prospect theory to computing it unless it's explicitly coded in. It's not there. Hopefully I've answered your question, Ishwar.
Mm-hmm. Well, I don't know if we will have another question.
I see a few people from UEL. Hi, guys. There's another one here. Can I just go ahead? As I missed the first 12 minutes, could you please again briefly mention about the relation between high frequency traders and stock exchanges? Yeah, sure. I think in the first 12 minutes, we just briefly discussed what a stock exchange was and how we buy and sell financial assets. High frequency traders are a type of player in stock markets. I think in the first 12 minutes, we would have probably just discussed there are human beings that buy and sell stocks and shares. There are high frequency traders that also buy and sell stocks and shares. They're in the same market. And we discussed how they were rather different from each other. Human beings are much slower. They sometimes irrational. High frequency traders are designed to gather vast amounts of information, and they are simply lines of code which try and process the information and decide, do they need to change prices and trade, or do they need to sit still? Hopefully that's a reasonable 2-minute summary. I believe they're going to share the recording of this actually, so.
This will be shared on the social media channels of the university. And if you don't mind, Michael, perhaps we can share your LinkedIn account or any kind of contacts.
Yeah, LinkedIn, Twitter, emails, anything.
Okay, perfect. Thank you very much.
Oh, just a bit of shameless advertising. If you do want a slightly more advanced version of this, my own university is hosting an event on the 31st of July.
Okay, that could be...
If I've captured your interest, do follow me on LinkedIn so you can get the details of that.
We will. In any case, let's see if we have another question. We have some
great
by Rahul.
Is there any more in there?
Well, I think that's gonna be it.
Okay.
Okay, so thank you very much, Michael. You shared your knowledge and your research with us. It was very interesting. As I mentioned before, it's a topic that's not very common. We don't really read or hear about it enough, I guess. You've taught us that by a topic that seemed very complicated, we can all get a grip on it. We can also learn from behavioral economics. It was very insightful from my opinion. So as we said, the talk will be shared on social media. It has been recorded. I will send a copy of the recording, especially to you, Michael. And for the other participants, for the next newsletter of the university, we have some speeches and some other conference prepared, so you can keep an eye on it. And thank you to everyone that participated also today. And Michael, thanks again. It's been a very nice talk and a very nice discussion.
Great. Thank you very much for coming along. And of course, many thanks to Celia for organising today's event.
Thank you. We'll keep discussing this, I think. I still have a lot of questions, so I will be approaching
I'm going to get a nasty email, aren't I?
With Hayek and Keynes, I'm sure.
You're more politically minded than I am.
We'll see. Anyway, thank you a lot, and we'll keep in touch.
Perfect. Okay. Thank you very much, everyone. Have a nice day.
Thank you.